Here is something very deceptive about trading. When you log yourself into your brokerage account, when you log yourself into your centralized exchange, into your Coinbase, into your Binance account, all the assets look pretty much the same. You select Bitcoin, or you select a meme coin, or you select, say, the oil price or the S&P 500. It's all just lines on a chart, right? They go up and down, and the target is obviously to buy low and sell high. So the game looks pretty much the same, right? Whether or not you're buying Bitcoin or the S&P 500 or silver or gold or pork bellies, whatever it is, it looks like it's pretty much the same game. You're simply buying an asset low, you're selling it high. It almost doesn't really matter what kind of assets you're trading. But this is actually very deceptive. Trading in the pork belly market is very different to trading, say, the global currency markets. And that's because the way to get an edge in the market, the way to gain versus the average market participant over a long time, despite all of the luck component that we've got, is not dependent on what kind of technical indicators one uses on charts. It's not dependent on what kind of lines you draw on charts. It's dependent on gathering and processing information that other people don't have or that other people don't bother gathering. Because here's how to think about this fundamentally, right? If you want to be buying low and selling high, then you have to be buying when other people think the price is likely going to further go down from here. When you want to be selling high, somebody else needs to think that the price continues to go high. So you need to have a better gauge on where the price might be going. You need to have a better idea of what the fair value of the price is, or where simply demand and supply could be shifting, maybe based on social trends, maybe not even based on intrinsic value. You need to estimate this better than the average market participant. Now, estimating this for a meme coin is very different to estimating supply and demand, say, for the global currency markets. When you're trading global currencies, you have to think about, say, large global M&A transactions. Let's say a large gold mine in South Africa gets purchased. Then probably the local currency will shortly spike up, right? Because there will be a lot of demand for that currency. Or let's say you've got an idea of where interest rates might be going because you're studying very well the central banks of certain countries, and you have an idea, okay, the interest rates might get adjusted in a certain direction. This will also have a very large impact on the prices, right? On the relative prices of currencies, of course. But if you're trying to estimate where, say, a meme coin price is going, then you have to look at very different factors, right? Then you have to look at, say, social metrics. You have to see how quick is, say, the Twitter account of this meme coin growing? How quickly is, say, the YouTube account growing? What's the attention in general on this particular asset, right? How many Google searches are there? You're looking at very different metrics to estimate where supply and demand is going. And so this is a problem because most people treat every asset the same. The beginners treat every asset the same. They simply just look at the price movements and they think, okay, the price is moving in a certain trend line. And of course, support and resistance lines do have some merit to it, but definitely should not be the main cause why you're buying an asset. The main reason why you're buying an asset should be because you have insight why there might be upcoming demand in the future. And so different markets require very different kinds of analytical skills. And the competition in different markets is also very, very different. If you're trying to beat the currency markets, you've got very large hedge funds against you. You've got the quants against you. You've got the Einsteins of this world against you. You've got very hard competition to estimate those bottoms and highs better than the average. However, when you're trading a small meme coin, where you've got tens of thousands of meme coins being issued every week, every month, then you've got a way more fragmented market. You've got also way smaller assets. So even if you're right with estimating the bottoms and the tops, you wouldn't make as much money because there's not as much liquidity in the market. So the Einsteins of this world, right, that make millions and millions of dollars in the currency market, they're not going to bother with trading a meme coin that's got $50,000 in liquidity. Even if they could double their capital, maybe they could only deploy, say, $10,000, double this. That's not really interesting for the people that are already at those kind of very high levels. So what does this mean for us? I believe it means two things. The first thing is it makes sense to specialize on the markets that are comparatively small. So you don't want to specialize on currency trading. You want to specialize on small meme coin trading, for instance. The second thing is, it's not just size that matters, it's also fungibility that matters. A US dollar in America is the same as a US dollar in the Philippines, right? They both trade the same kinds of US dollars. It's super fungible, it's a huge market. However, if you're trading property or you're trading cars, you've got all kinds of different variables that impact the price, right? It's age, it's condition, it's when has the last maintenance been done, it's mileage, it's rarity, it's all kinds of things that could potentially impact the fair value of a car. So estimating the fair value of a car is way harder than estimating the fair value, so to speak, of a currency, or say of Bitcoin. The more fragmented a market is, and the smaller a market is, the weaker as per tendency your competition is.
Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com.
And intuitively, that also makes a lot of sense, right? If you are dealing with very small transactions, you're probably not that much worried about fair pricing, right? When you buy a bag of potato chips, if that bag of potato chips is now 20-30% more expensive, it doesn't really matter that much, right? Sometimes you might just spend that additional money. If you buy a coffee, right, at Starbucks and it's marked up by a multiple X, you're not really worrying about it that much. If you're buying a plane ticket though, that you want to fly, say 5 or 10 hours somewhere, suddenly 10 or 20% of a difference does matter to you, right? Then you want to see this additional value for the additional 20%. Say you spend 20% more on the plane ticket, then you want to see that maybe the departure time and the arrival time is more convenient, or maybe you want to have better service and you don't want to just be served by a budget airline where you have to pay your own meal in flight, right? So those are then the kind of differences you suddenly start looking at. It doesn't really matter that much for the bag of potato chips, you're simply just buying it. So the higher the ticket price, the more money is moving on a single transaction, the more efficient the market tends to be, the more people tend to look at whether or not they get the value for something. And if you're trading very small ticket items, if it's a very illiquid market, if it's just small meme coins, or if it's just, say, the flea market, etc., then those kinds of markets tend to be less efficient. Those kinds of markets tend to be easier to beat. And those are the kinds of markets you want to start out with. Those are the kinds of markets where you get your first confidence whether or not you can beat anything. So I learned this with online poker actually. I have an online poker background. So back in the days, more than 10 years ago, online poker was the big thing, right? And if you analyzed online poker very, very deeply, if you had your databases where you would track other players, you knew their behavior, if you knew in general the statistics around poker, you knew the probabilities, you could, even after the fees that the casino take, make money with this. Only a small fraction of players make money with it, but if you study the game enough, you could make money with it. However, there was also a differentiation there. If you played for the very, very small amounts, where you only had, say, $1 or $2 of a buy-in, then your opponents would be very weak, because your opponents would also just play with play money, right? They would just join for entertainment. So beating those games are relatively easy. However, once you play for games with $1,000 buy-in, suddenly a lot of people that you play with take this way more seriously. A lot of people might be more informed. Beating those games is much harder. And so there's the exact same equivalent in regular markets as well. You want to be playing for the $1 or $2 games first. And you want to learn the game this way. You want to understand how to time the market. You want to understand how to get a market edge. You want to understand how to gather data most people don't have. You want to understand how to process this data. You want to understand risk management, right? That in case you do have a wrong trade, that you don't just totally crush your portfolio. You want to understand all of those basics in the easy markets, there is no rush whatsoever to start trying to beat, say, the S&P 500. Right? There's no need to try to buy low the general stock market and sell it high when there's so much competition. It's much easier to beat the simple markets, right? The illiquid markets, the markets where there's a lot of stupid money involved. So try to find those pockets of the market, right? Try to find small markets where there are a lot of beginners. Try to beat those markets. Be very careful. Do this as a learning exercise, not as an exercise to become a millionaire tomorrow. Try to gauge where your skills currently are at. And if right now you can't already beat those easy markets, then there's no chance on earth that you will be able to beat the harder markets. So you can simply play those easy small markets for a while first, and only once you get consistent gains, and only once liquidity dries up relative to your order size, and you want to bet more than, say, $10,000 on a bet, only then you have to go up a level, right? Only then you have to compete with the bigger fish. There's no need whatsoever to take on all of that tough competition, especially when you're starting out, because then in the end, you can't really differentiate what is actually luck versus what is skill. Because there is, of course, a big luck component involved as well, right? If you do just a few trades every now and then you might end up confusing skill for luck, right? Because the luck component on a small sample size is still very high. But if you're trading very frequently a very inefficient market, then after a while, if you are very informed, you know what is luck and what is skill. So just because you can trade currencies and meme coins on the same platform doesn't mean that it's the same game. Just because they're plotted the same way on your screen and they all have the same kind of rules to buy low and sell high doesn't mean it's the same game. The way to gauge future demand and future supply is very, very different for the small illiquid markets versus the not so illiquid markets. I believe it makes sense to first focus on one market first. Don't try to beat DeFi and meme coins and stocks at the same time. Focus on one thing, be this crypto gaming, be this meme coins, be this DeFi, whatever it is, focus on one thing and try to learn this as deeply as possible. Try to become the top 5% in that field. Trade this for a while, get some sample size, and once you've got the confidence, you can still move on if it's even worth it. Sometimes you might simply just stick with one single thing, at least during the time period where this market still continues to expand. Of course, in the end, where it becomes expert player versus expert player, it's way tougher, then it might make sense at some point to move on. If you haven't yet joined our Telegram, feel free to do so. The link is down below. Looking very much forward to chatting with you. If it's your first time here, of course, feel free to subscribe as well. A like would be very much appreciated as well. See you on Telegram. Cheers.